You know, most people think the infinite banking concept is only for the wealthy or only available to people of certain ages. But you know what? It can be one of the most powerful tools, no matter if you're 20, 40, or 60 years old. In this three-part series, I'm gonna break down how the infinite banking concept works in every stage of life. Because your money problems change as you grow, and so should your strategy. From student loans and debt in your 20s, to buying a house, raising your kids, saving for retirement in your 30s and 40s, to protecting your wealth and building a legacy in your 50s and beyond. The infinite banking concept adapts for all stages of your life. And it puts you back in control, which is something the banks and Wall Street certainly don't want. So whether you're just starting out, planning your retirement, or you're in that legacy phase of your life, there's never a better time to start taking back control of your money. Let's dive into part one, ages 20 to 40, on how they can become their own bank. So the first age group is 20 to 24 years old. And you know what? I remember this age group. It was awesome, right? You're just coming out of school in most cases. Some people are still in school. You're starting to figure things out, or at least figure out what it is you want to do or what you like to do. But the problem is you're just getting started, so your income is relatively low. I know mine was extremely low. Anywhere between $35,000 and $40,000 a year by today's standards. Your average savings is next to nothing. 3 to 5 grand would be the average across the whole country. And then most, like I said, are still in school. They're either in school or starting their careers or starting to do internships. But the problem is you're really burdened by debt with low wages. You've got lots of student loans. You probably have some credit card debt, maybe a car loan. But nonetheless, the income just is not enough to really service all the debts. And maybe some of you are buying a car at that point. So it really kind of comes down to time is the one thing you have at this stage. Or at least most 20 to 24-year-olds, they don't think they have a lot of time, but they have a lot more time than they will in the coming years. So you have time and you have energy. So the most important thing when we think about how do we start getting ahead here, we got to use our time. And your time's got to be spent doing something that's productive, something that moves you ahead. And you know what? In today's world, getting ahead is super easy. You just have to do that much more than everybody else. Literally, the level is so low that all you have to do is just a little bit more. So let's talk about that a little bit more. If you're between 20 and 24 years old, what you really should be thinking about is how do you save just a little bit more than everybody else? How do you start applying your money to make sure that you have a better start? Well, that's the interesting part. A lot of people at this age, they're not saving money at all. Money comes in and it goes right back out the door. But just imagine if every single week, every month, every pay period, all you did is you just took 10%. That's not a lot, 10%. You got it out of your main bank account and you got it somewhere where that money isn't going to be touched. No debit card, no checks, just an account that starts to grow and build some wealth. When I think back to myself at this age, I was really doing what I loved. I was. But I still had a lot of time. And that time could have been much better used. I spent a lot of that time, well, just having more fun. And hey, listen, I'm not faulting you if that's what you're doing. But what if, just what if, one day a week you worked a second job? One day a week you went out and did some side hustles. One day a week you did something that was income generating. And the income you made from that one day in the week, you set that money aside. You set it up so that you would be in control of your money a little bit later in life. And I don't mean a lot later, because I know it's hard to think about anything other than right here, right now. And I don't disagree. But you know what? When you're a little bit older, you're going to wish you had taken this advice. So, one day a week, that's all. Go out there, make extra money, put that money into your own private banking system. Now, to get started with that, it's easy because you're young, because you're healthy, because you've got energy. So what we're going to do is we're going to set that up, and we're going to set it up with the small amounts. You know what? When I was 23 years old, I did this. And it wasn't a lot of money. It was just a smidgen over $200 a month. Now, today, you could maybe do a little bit more than that. But back then, that was a ton of money. I remember when I set this up, it was an automatic deduction from my checking account into a whole life insurance policy that I set up for myself. Because at that time, at 23, I had just entered the financial advisory world. I had just become a financial services representative. So obviously, if I was going to go out and talk to people about something, I needed to be practicing what I preach. $200 a month was a stretch. But you know what? Once I did it, the first couple months, maybe it was a bit tough. But after that, it became easier. I built it into my routine. I did extra side jobs to make sure that that $200 was there. And as that money was put away, it built and it grew. And you know what? I'll cover what I did with that because it was a little bit later, around the 27-year-old mark, where I bought my first flip, my first piece of real estate. And you know where the money came from? Yep, that account, my private banking system. Now, back then, I didn't know anything about what you're learning about right now. I just knew that I had to put money away, I had to save, and I knew that real estate was going to be one of those investments I had to get to know, like, and understand. But whatever it is for you, we got to focus on some things. We got to focus on getting started because we got to change this. The average savings of $3,000 to $5,000, we want this to be a little bit higher for you. So get started now. Now the debts, I know those are going to be difficult, but we're going to cover those in the next phase because at this phase, it's about saving and starting to accumulate so that the next phase, we're going to pay off all your debts. We're going to get rid of your debts, but we're going to do it while building wealth. I always say, you're going to build wealth through your own debts and expenses. Doesn't that sound fun? But first, we got to apply the savings component. The first law of wealth, keep 10% of what you make. And how I did that? 1 day a week. That money is what I put into that whole life insurance policy. And that is what allowed me to get ahead. Now let me talk about what you absolutely need to stop doing. At this age, you have one of two things that are going to happen. You're going to get yourself in a bunch of debt, which you're going to be paying for the rest of your life. Or you're going to make some changes now that are going to make sure that you're never going to have to worry about that in your whole life. You're going to be calling the shots because you're going to be in control of your money and you're going to be the bank, which means everything you buy, you're going to make payments to your bank. Let's stop living paycheck to paycheck. Let's stop buying things with money we don't have, which is called getting yourself in debt. And let's start planning so that you are going to live differently than everybody else you surround yourself with. And now, they might be saying you're stupid today for doing this, but they'll be the ones coming to you for advice later on. Don't believe me? Well, try it. So this is a really great age. 25 to 29. Gosh, I remember this. And I had a lot of fun at this age, and I'm sure you're going to, or you already are. Because at this stage, your median income is between $45,000 and $55,000. You're making significantly more money. And you're making more money because your career has progressed. All those years you spent preparing yourself to get into this career or whatever it is you're doing, you're starting to be paid. However, life is also coming around and serving you some hard knocks. Because at this age, the debts that you started earlier in life are starting to get bigger. Not only are they getting bigger, the pressure is increasing. There's a lot more pressure than there was when you were younger. Pressure to perform, pressure to move up in your career, pressure to go out and start a family, pressure to start thinking about buying a home if you haven't already. All those decisions start making life more difficult. However, your savings, well, based on the average, is starting to go up. Here's the problem. Although your savings is going up, most of the savings at this age range is going into a 401k. You are not in control of that. You're putting money away for a future goal called retirement, which means you're putting it away till age 59 and a half. But if you listen to me about that first age group, well, now all of a sudden you've got savings, you've got liquidity, you've got the ability to invest in things you know, like, and understand. Like for me, it was real estate, and you really start making some decisions that move you in a positive direction, not debts. But you see, now what we can start doing is, even if you have a 401k, here's some good advice about your 401k. Don't avoid it. Put money into the 401k, but try to only put in up to what they will give you in a match. Now the match is, if you put 4% of your pay in, maybe your company will match 4%. Or maybe it's 50 cents on the dollar up to 3%. So then you're gonna put in 6 to get the full percentage. Whatever it takes, and ask your administrator, whatever it takes to max out the match, that's how much you put in there. The rest of it, you put into your own private banking system. But hopefully you started that private banking system when you were younger, because now it's starting to really build. And now what we're gonna do is we're gonna use that private banking system to turn your debts into your wealth. We're gonna create wealth through your debts and expenses. Now let me show you how that works. Now most likely, a lot of you at this age have not started your own private banking system. You probably haven't started that specially designed and engineered whole life policy that I'm always talking about. That's fine, because right now is the time. You've got the extra income. You've got the extra savings. You're starting to make those changes. You're starting to move up. This is the moment where you begin. And this is great. I mean, having an average of $10,000 to $20,000 in savings is phenomenal, but let's use that to build your foundation so that you then can catapult from that. You can use compounding interest to get yourself where you need to be without having to work harder. Because up to this point, you have got where you're at by working really hard. And now we're gonna start making your money work for you. Let me show you what that looks like. So I'm gonna keep this super simple, but you wanna be your own bank. You wanna take back control of your money. And how are you gonna do it? Well, it's gonna be one change. That's all we're gonna do. We're gonna change one thing, and that is where your income goes first. That's it. Just your savings portion. So let's call that the 10%, because we wanna go with 10%. It's a simple number. So if you're making 50, it's $5,000. 10% is what we're aiming for. And we're gonna put that money into an account that's gonna be your own bank. I already said what it is: specially designed and engineered whole life insurance policy. Now you might stop there and you might start questioning, because hey, that's great. Let's debate it. Why would you put money into a specially designed whole life? Well, if I was comparing this to the alternatives, which would be a bank account, I would look at almost a T-chart and I'd say, okay, which one's better? Well, let's talk a little bit about the whole life insurance policy. First off, a whole life insurance policy right in the contract guarantees an interest rate. So you might be saying, well, how much is that guaranteed interest rate? It depends on the carrier, but let's just use one of the main carriers we use, which guarantees 3.25%. Now you might think that that's not a good number. You might even say, I make more than that in my bank account. But you see, what if every year the insurance company paid you a dividend on that, okay? Which they have every year since these companies have been around, which for all the companies is well in excess of 130 years old. Okay, so all the companies have paid dividends every single year for over 30 years. So now, if I were to add the guaranteed interest to the dividend, what that's gonna do is get us a dividend crediting rate between 5.7 and over 6%. So now let me rephrase that question. How much are you making in your bank account? How about your savings account? Are you making more than that? Probably not. And even if you are, is it guaranteed? The answer is 100% no. Because when the Fed decides to drop interest rates like they just did, your interest rate goes down, but this one is contractually guaranteed. But hold on, let's keep going, because we want to keep comparing. This, specially designed whole life, if designed properly, grows tax-free. So the internal buildup of your cash value grows tax-free. Your bank account's not growing tax-free. Not only that, this account is protected in most states from judgments and liens. So you add a layer of protection that is not found with your bank account. Plus, later in life, like I mentioned, legacy and your family is going to become very important. You're going to want to make sure that they're taken care of if for some reason you're no longer here. So when we start looking at this T-chart of the bank or the high yield savings, let's call it, in this specially designed whole life, where is it that we're losing. And some people would say, well, if I put money in this specially designed whole life, I can't use it. No, that's a regular whole life. We design high early cash value policies that give you access to your money immediately in the first 30 days. So let's just play along with this. Let's say somebody sets up one of these policies and they're saving $500 a month. In the first quarter, let's just say they've put $1,500 into it. But over here on this side, they've got debts. And let's just say they've got a credit card debt that is $1,000 that is charging them 20% interest, and they're paying $50 a month on that credit card. This might be a real example for some of you. So let's just think about this. We've put $1,500 into our policy, but we have a debt over here that's $1,000 that we're losing 20% because that's what they're charging us, and $50 a month right now is leaving our system forever. It's leaving your family and your household forever. We're going to change that. So what we're going to do is we're going to go into the policy, and this could be immediately in the first 30 days, and we're going to take $1,000 of the $1,500 we put in there. We're going to take that out to pay off this credit card. But you know what? I'm going to say a swear word. We're going to take that as a loan. So let me just unpack this real quick. Why would we take our own money as a loan? Well, this is a very simple explanation. You remember that dividend crediting rate we were earning? What if we could earn that on all the money in the policy? So let's say you put $1,500 in and you have $1,000 earning interest and dividends at a rate of 5.7 to 6+%. Do you want to disrupt that just to pay off a credit card? I mean, that would make sense, right? If you're making 6 and you're paying 20, we'd still be making a spread. But what if we never had to touch our own money? We could just borrow from the insurance company and they wouldn't ask us any questions. It's not like a loan application you got to do. You just go online, you click a button, it asks 4 questions, and one of those questions is what bank account do you want it sent to, and that's it. So now, immediately in the first 30 days, $1,000 was sent to your bank account. But you see, we set up a segregated bank account, a bank account that's just going to be used for this purpose of you becoming your own bank. So now $1,000 is in the bank. We write a check and we pay off this credit card. So now the credit card's gone. You're no longer paying them. But what we're now going to do is we're going to do something that is the most important part of you being your own bank. The $50 a month that you used to pay to the credit card that we no longer owe, we're going to take that $50 a month and we're going to pay that back to our bank, back to our policy. Because if we used a loan from our bank to pay off their bank, well then why wouldn't it make sense to pay the $50 a month you were giving them back to our bank? Well, it would make sense. And when you do that, you change the entire dynamic. You go from debt to wealth. Here's how. The $50 a month that you were paying them, that represented 20% interest because that's what the credit card was charging you. Now, when you put $50 a month back into your policy, it's like recapturing 20%. Plus, the $50 you put back in your policy is available the very next day when the check clears. Plus, if we started with $1,000, the insurance company, let's just say, charged us 5% hypothetically. I'm just making numbers up. Okay, they charged you 5% on that $1,000. Every month, we're repaying $50 of that $1,000. So after month 1, when you put the $50 back into the policy, that was put back in as a loan repayment. But you lost no liquidity of that money. Plus, all $1,000 of your money has been, for that entire period, earning interest and dividends. So you've been earning uninterrupted compounding interest. Your money's been working for you, even though you took the money out to pay off the debt. And remember, we had $1,000 in the policy earning interest and dividends, and that $1,000 is still in the account earning uninterrupted compounding interest while we got to use the money to knock down our debt. And then every payment, every $50 we put back is money you are using to build your wealth. But not only build your wealth, that $50 is repaying the loan to the insurance company, to which they were charging 5% interest hypothetically, okay? Because it could be 5, could be 6, it does vary, okay? But now, if you had a $1,000 loan you took out that you paid $50 a month back to, $950 is what's left. $950 is what the insurance company is calculating the interest, because here's a unique thing. The insurance company only charges you interest one time per year on your policy anniversary. So you're not losing to monthly payments back to the insurance company. What you're doing is you're taking the $50 that you used to lose, you're now putting it back into the policy, which is giving you liquidity, and at the same time, it's knocking the debt down, reducing the APR that you're paying to the insurance company, because they're charging interest rate on a lower declining balance. You are building wealth through your own debts and expenses. Then you just rinse and repeat. You just keep doing the same thing. The money's coming into the policy. We're letting it build up. You're recycling and recapturing money that you used to give away. And then what do? We go right down the line. Eventually, we pay off the car loan and we recapture the car loan. We pay off other debts. We recapture those debts. And eventually, we start looking for opportunities to make our money go to work for us. But we always start with the holes in the boat. And the holes in the boat are the debts you have. We have to convert them from debts to assets. And how we do that is by being your own bank. So now that I've explained the process called the infinite banking concepts of you becoming your own bank, now could you see how you're going to start building wealth through the problems that most people this age range has? So now could you see how you're so much further ahead of everybody else because you are using your debts to build wealth. You are already starting to save, and that savings is allowing your money to work for you 24/7. That money, in some of your cases, was going to a 401k because you were trying to max that out for a goal that is so far in the future, it's hard to really get ahead today. So we just took money that you were putting into the 401k, money you were putting into a high yield savings or a bank account, and we just redirected that money so that it starts working for you in a different way. Now let me go one step further, because as time goes by, we become a little bit older. 30 to 40, this is a pivotal period of time because you're in your prime career growth phase. You're making between $55,000 and $60,000, says the median income. Your average savings is 30 to 40, but unfortunately, if you're the average, most of that is sitting in your 401k or your retirement account. Again, prime career growth, but now your expenses have gone up tremendously. They've gone up because you probably have a mortgage. So you got a mortgage payment that you didn't have before. You probably have children. So you've got childcare and all the expenses that come along with children. And boy, are children expensive. And not only that, you're upgrading your lifestyle. You're getting in those peak years, so you want to kind of keep up with the Joneses. You want to live a good life and have those things. But if all that comes at the expense of you building wealth, we have a real conundrum. We got to figure out which is more important. Again, if you recall, I showed a second ago how to build your own banking system, how to do that by changing one thing, and that is where your savings goes first. Redirecting where the savings is going from the 401k, just put in just the match, redirect the rest into your own private banking system, into that specially designed whole life. And then what we are doing is we're taking the debts we've created up to this point, we're using them to build wealth. We're getting rid of the debts, and now everything else you're going to do, from your mortgage to your kids' college funding, your kids' schooling, all the things that you would borrow for, we're borrowing from our own banking system. It's a pretty easy solution. It started when you were younger, and even if you didn't start then, this is the peak time to get started. So, revert back to what I said. Change one thing, where your savings goes first, and then add one step. Think as if you are the bank. Start applying the system called the infinite banking concepts, which allows you to not leak money anymore, but to keep and control every dollar you make. That's the secret. And in the next video I do, which is the second part of this series, we are going to cover that retirement because it is so important. You don't want to be working your whole life. You want your money working for you, but we are going to cover that next. We're going to show you how this entire system not only takes care of your debts, takes care of making sure you don't need banks and you don't have to be relying on them, but also you're building your retirement as well. So we will cover that. So here we are. All I'm asking you to do is start the process of learning the infinite banking concepts. That process will help you throughout your entire life. It will start to set the pace so that others start asking you how you're doing what you're doing, and you can sit there and say to them, my money has been working for me uninterrupted since a young age. Your age, whatever it is, if you're in any one of these ranges, that's what you need to do. So there are laws to wealth, and those are what you need to start applying. The first law we covered in depth, keep 10% of what you make. Law number 2 is keep your money working for you. And law number 3 is protect your wealth. Protect your wealth by investing in things that you know, like, and understand. And you know what? All we covered was debts, debts, and debts. You know them, you don't like them, and you're giving money away. So let's recycle and recapture the money you're giving away, and that will allow you to build wealth through your own debts and expenses. Now listen, there's a lot more to this. And I'm gonna give you a video at the end of this that will lay it all out. Because, hey, listen, cars, we all love cars, right? What if you could get all the money back for every car you buy, drive, and own? Well, that's coming soon. If you've liked what you've seen here, hit that little subscribe button right there. And also, while you're at it, there's a little bell up top. Smash that bell so that every time I put out new content or I go live, you're notified. Hey, and while you're at it, check this video out right here, The Secrets of the Wealthy. The video that will lay out all the fundamentals of exactly what we just went through. Thanks. We'll see you on the next one.